Senator Kevin Cramer, thank you so much for joining us.
My honor. Thank you for the opportunity.
Senator, you've penned a letter to the director of the FHFA with quite a few of your colleagues. Could you tell us what is going on here?
Well, it's the most nonsensical economic policy I've seen yet, and we've seen a lot of weird ones lately. But what's going on is the Federal Home Finance Agency came up with a new rule that they implemented on May 1st. And what the rule does is it takes people who have a lower credit score and gives them beneficial financial treatment for loans, but pays for it by taking money from people who have a higher credit score. So if you have a credit score of 679 or lower, you get beneficial terms. If you have a credit score of 680 to 780 and have a 15 to 20% down payment on your mortgage, you're going to get extra fees attached to that, to the tune of about $30,000 over the life of the loan, to subsidize the people with the lower credit rating. It is the most perverse incentive I've seen, well, really since forgiving student loan debt.
It has eerie similarities to socialism and communism, in my opinion.
It's hard to describe it as anything other than socialism or communism. It's actually a textbook definition of socialism.
Indeed. I just want to read an excerpt from your letter and get your response to it. The letter says in part, this will distort the cost of lending in the U.S. housing markets, making the entire system less efficient and costlier for all Americans. How so?
Well, anytime the government steps in and manipulates a market like this, just remember back a few years ago, right, when we had the mortgage crisis that collapsed. We had a similar situation that collapsed the entire economy because you had incentives for people to borrow money that shouldn't probably be borrowing money. Well, that has to be paid for somewhere else. That's being paid for, in this case, by people with good credit. So that creates an obvious inefficiency in the lending process. All of that at a time when we're on the verge, perhaps, of a banking crisis. Let's hope that doesn't happen. I think we need to do more things to avoid that, to prevent that. We already are in economic crisis. We're on the verge of a recession while we're experiencing inflation. Interest rates have gone up now, as of yesterday, 10 times in a row. So everything's wrong, and then they throw this on top of it, which is further wrong.
Senator, I know you don't have a crystal ball, but what do you think it will ultimately take to start getting those interest rates down?
Yeah, so it's going to take a long time is what it's going to take, but what has to happen generally, simply speaking, is inflation has to get lower than the interest rate. But inflation is moving very, very slowly downward, and it's still inflation. In other words, we oftentimes measure it compared to inflation the month before, but remember, it's still high. So once it gets below the rate, I think you can stop raising rates. But that's not the same thing as lowering rates. So I think we're going to have to work through some very, very tough months here, and maybe a couple of years before we actually see the rates come back down.
And to your point, this new rule that they're trying to implement, it comes, as you mentioned, at a time of extreme uncertainty between interest rates continue to rise. We're seeing First Republic Bank, the latest bank to collapse. The timing seems a little bit tricky.
Well, it's tricky for sure. It's nonsensical for sure. And I'm not sure what's motivating. I know in an election cycle, presidents like to do things that take other people's money and sort of spread it around. That's basically what socialism is. But this one has such dire consequences because it can help collapse an economy. And certainly home ownership, which the thing they're trying to fix or the thing they're trying to spread is the dream of home ownership. The very thing they could collapse is the dream of home ownership. Again, much like the mortgage crisis of the mid-2000s, first decade of the 2000s. So it's a very risky venture, to say the least. And it's not, when I say risky, I mean it runs a risk of a complete collapse. But on its face, it's already got negative consequences because it disincentivizes people to have a good credit rating. And by the way, credit rating is not necessarily attached to how much money you have. My parents, when I was growing up, they're both deceased now, but they were middle class, lower middle class, worked hard, had good credit rating because they didn't borrow a lot of money. They paid their debts on time. They didn't take on credit card debt, so they'd have a good credit rating. They would literally, in this scenario, be paying or subsidizing people who make 2, 3, 4 times as much money.
It's a great point. A lot of people sacrifice so much to keep
right.
that and have less because of that.
Yeah. So it's a perverse incentive, but the government's good at perverse incentives. But this one's weirder than most.